Well, hey everyone, welcome to this vodcast, Managerial Accounting and Cost Concepts. I'm your Professor Jeff Byrne. I'm excited to be with you. In this vodcast, I'll cover how managers need to rely on different cost classifications for different purposes. We'll talk about how cost objects like a product or a service and how their costs get assigned. Cost behaviors used to prepare financial statements. Cost principles used to forecast the future, and costs that are relevant to decision making. Plus, the contribution margin income statement, a handy reorganized income statement used by company insiders and managers. All of that and more in this podcast. Managerial accounting is concerned with providing information so that managers can formulate plans, control operations, and make decisions. Well, to plan, control, and decide, you've got to understand cost. Costs are traced based on the cost object. What is a cost object? Well, it's anything you want to measure the cost of. A product, a service, a customer, a region, your downtown office, whatever. Now we split cost into two buckets, direct and indirect. A direct cost, it's traceable. It clearly belongs to one specific cost object, like the salary of a Chick-fil-A manager at the Buckhead store. That's a direct cost to that location. Indirect costs, well, they're fuzzier. They support multiple cost objects and can't easily be traced to just one. Like the Coca-Cola plant manager. They oversee sodas, water, energy drinks. Their salary supports all of it. So it's an indirect or a common cost. Other things would be like plant utilities, maybe even the plant rent. Here's the fun twist. Context matters. That manager's salary might be indirect, say, to Powerade, but direct for the whole beverage division. It all depends on what you're trying to measure. Let's start our tour of cost types in the manufacturing world. Because manufacturers, they do everything. They buy raw materials, build stuff, ship it, market it. If you can understand cost in that setting, you'll be ready for anything from nonprofits to tech startups. Now, manufacturing costs fall into three buckets: direct materials, the raw ingredients; direct labor, the people physically assembling the product; manufacturing overhead, all of the indirect stuff. We'll talk about that in a second. Think about it like Monday night brewing. The hops and the grain. Which bucket would those fall into? Direct materials. How about the person bottling it? That'd be direct labor. The lights, cleaning supplies, building maintenance. What is that? You've got this. That's overhead. Let's talk materials. The stuff that goes into making something. Here's a big steak and ketchup. We'll come back to that. When it comes to materials, some are direct materials, like an engine or a car seat, big, traceable, worth tracking. But some things like the glue used in the car's trim, too minor to track individually. These are indirect materials, and they get rolled into manufacturing overhead. Now it's steak time. Say you're thinking of hosting a cookout. The steak, what would that be? Well, that's a direct cost. How about the ketchup? What would that be? That's an indirect cost. No one's counting ketchup used per person. Just like there's direct and indirect materials, the same holds true for labor, direct and indirect labor. Direct labor, we call that the touch cost. It's the hands-on team, the folks at Kia wiring dashboards. But lots of essential factory roles don't touch the product directly. Production supervisors, maintenance, production janitorial, that's indirect. So next time you hear labor, ask, can we trace this person's time to a single unit? If yes, direct. If no, indirect. Here is that big bucket, manufacturing overhead. It's all the production costs that aren't direct materials or aren't direct labor. They become part of overhead, which is, since it can't be easily tracked to a cost object, it gets assigned in some systematic fashion. Overhead includes indirect materials like glue, indirect labor like the janitor, factory-related stuff like depreciation, utilities, factory-related taxes, insurance, maintenance. Just remember factory cost only. If the cost of the corporate office, if that's what it is, it's not overhead, it's administration. Okay, time to throw in some classic terms. First, prime cost. That equals direct materials plus direct labor. Conversion cost equals direct labor plus manufacturing overhead. Prime cost, that's really the raw stuff, the hands-on work. Conversion cost, what's transformed from raw into finished. These are old school terms, but still useful for grouping cost logically, even if they sound like something from a 1920s factory. Now let's step outside the factory with SG&A. Selling costs get the product into the customer's hands. These are the ad costs, shipping, sales, commissions. General and administrative costs are the behind the scenes teams like executives, HR, legal, IT. Together they're called SG&A, and they show up separately on the income statement. They show up directly on the income statement. If it's not tied to the factory, it's SG&A. Now we move where costs happen to when they hit the books. Product cost. Direct materials, direct labor, overhead stick with the product as the product becomes inventory. These costs, direct material, direct labor, overhead, they attach to the inventory, become part of the inventory's cost. And those costs stay on the balance sheet as inventory until what happens to that inventory? Until it's sold. And then it becomes a period cost, particularly cost of goods sold. Once the product is sold, those costs that we stored on the income statement, they get released, they get expensed. So think Coke's inventory, all the costs to make it become part of the inventory. Those costs are only expensed as cost of goods sold when the inventory is sold. Period cost, SG&A, those get expensed immediately. Your billboard cost for the second quarter ad campaign, that hits the books this quarter, no waiting whatsoever. Let's talk about how costs behave. Some are flexible, some are stubborn, some do their own thing entirely. Cost behavior is how costs respond to a change in activity, like units sold, services delivered. They get broken into variable, mixed, and fixed cost. Your organization's cost structure, it's a blend of these. It shapes how the company plans, how they grow, how they pivot. Variable cost, they move in total, but they stay the same per unit. They vary in relation to an activity, like units produced, hours worked, or customers served. If ATL Whitewater Adventures does catering that costs them $30 per guest on day-long trips, well then, if there are 0 trips, there's $0. If there's 250 guests, well then there's $7,500. If there's 500 guests, it's $15,000, but it's always $30 per guest. Now, fixed costs don't change in total even if the activity does. If ATL pays $500 a month for storage fee, that's fixed. They still pay whether they have 0 runs or 20, 30, 50 runs, whatever. But on a per unit basis, fixed costs drop as volumes rise. More people, smaller slice of the pie. Just don't make a mistake. Don't think of the lower per unit number for actual savings. The total cost hasn't changed. It's just being divided among a different number of tours. Fixed costs only stay fixed within a relevant range. Need to run more than your current setup allows? Well, you'll need to scale, and costs jump in steps. Think renting a second machine because the first one can only make 50 widgets per day. Once you go above 50 widgets, you need a second machine, and so on. Step variable and step fixed cost jump, not slide. Some costs are part fixed and part variable. We call these mixed costs. For example, ATL Whitewater Ventures, they're required to pay the state of Georgia an annual $25,000 licensing fee, plus $3,000 per trip they take down the river. Every time a customer goes down, For a rafting trip, another $3. 1,000 trips altogether? Well, that's $28,000. The formula is y equals A plus B times X. Y equals the total cost. A equals the fixed. B equals the variable per unit. X equals the activity level. Mixed costs are everywhere. Utilities, delivery, phone plans. Break them down. Be smarter. And here's an important tip. When making decisions, focus on the cost and the revenues that differ between options. That's what we call differential analysis. Differential cost analysis, differential revenue analysis. Say you're choosing between Ryder and Penske for a truck lease. One's $100,000, the other's $60,000. The differential cost, $40,000. Or maybe switching to a new sales channel that brings in $150K rather than $100K. That $50K, that's differential revenue. Only the difference matters. Anything that stays the same between the options, we can ignore it. It's not helping us to decide. So stay with me. One more thing, sunk cost. Sunk cost, it's an expense that has already been incurred and cannot be recovered. A classic example is the purchase of a non-refundable concert ticket. If you buy a ticket and at the last minute you can't attend, well, that money is gone, regardless of whether you choose to attend the concert or not. Depreciation is considered a sunk cost often in business because it represents a past expense that can't be recovered. Once an asset is purchased, the initial cost and any depreciation taken are already incurred and can't be reversed, regardless of any future decisions. The sunk cost fallacy is when people continue to invest in a failing endeavor because of the sunk cost already incurred. For example, staying with a poorly performing employee because you've already invested so much money in their training, well, that becomes part of that sunk cost fallacy. You're likely investing in a failing endeavor. Yet so many people fall into the trap of trying to justify past mistakes. Smart managers don't. Last up, let's talk income statements. Here's the traditional format. It's what you see in most financial reports. Sales minus cost of goods sold equals gross margin minus SG&A equals net income. Here's an example of this with Hayward Stores. They have sales of $100,000, cost of goods sold of $80,000 equals gross margin or gross profit of $20,000. SG&A of $11,000 equals net income of $9,000. Pay note as we move to the next slide that this SG&A, for example purposes, will include $3,000 of variable cost. Let's take a look at the contribution format income statement. This will be your new best friend for internal decisions. It's the income statement that's used by internal people like managers. It separates the cost by behavior, variable cost first and then fixed cost. We start with sales, subtract all variable expenses, cost of goods sold plus any other variable cost, and get the contribution margin. Contribution margin is just sales minus variable expenses. It says how much is left over to cover fixed cost and ideally make a profit. Let's look at Hayward Stores. Variable cost expenses of $83,000 out of the $100,000 of sales gives us this new term contribution margin of $17,000. Minus the fixed expenses of $8,000 gives us the net income of $9,000. Now, companies also break down contribution margin into units. Say Hayward's has average sales of $100 and average variable expenses on that sale of $83. That means each sale generates $17 in contribution margin. That $17 helps to whittle away at the fixed cost of $8,000. So how many units must be sold to break even, whittle away at all of the fixed cost of $8,000? Well, that's a simple calculation. We simply take the $8,000 divided by the $17 of contribution margin, and we need exactly 470.59 units of sales or units of contribution margin to whittle away at all of this fixed cost. We rounded up to 471, but let's use 470.59 to get precise. That generates $47,059 in sales, $39,059 in variable cost. Oh, and look, exactly $8,000 in contribution margin, enough to whittle away at all the fixed cost and break even. You'll find this format very handy. It's perfect for budgeting, cost volume profit analysis, even performance reviews. It helps you understand how changes in sales affect profits and avoids those wait, why are we losing money moments when volume shifts. A wrap for this vodcast. You now have a solid foundation in the key cost types and behaviors and two major ways to analyze company performance, and more importantly, why this matters. This stuff is the bedrock for everything to come, from budgeting to strategy to decision making. Get ready to use it all in class, in cases, and maybe even in your job before the semester is over. Let's go.